The clock is ticking. In less than 24 hours, news will drop that could change the course of economies, alter political landscapes, and impact your life. This is news you don't want to miss. I'm your host, Steve Metre, and thanks for joining me today. In our show today, we're on the brink of news that could redefine our future. Get ready because this is going to anger the Trump administration, disrupt markets, and impact every American household. Stay tuned as I break down everything you need to know about what's coming tomorrow. Plus, we have a sponsor for today's show. I'd like to welcome Mechanics Healthcare to the show. You can find them on the NASDAQ symbol IXHL, and they're pioneering the development of innovative combination of medicines of parasynthetic cannabinoids with established drug components to create effective low-dose treatments for chronic conditions such as obstructive sleep apnea, rheumatoid arthritis, and generalized anxiety disorder. And based on what news is coming tomorrow, the latter could be a problem for many because this is going to be the first time we hear Wall Street make a demand that they haven't made in a long time, and this is just one of the many things coming tomorrow. Let's pick today's story up with a headline. As NVIDIA, OpenAI Sam Altman responded DeepSeek development. And why is this going to be the forefront of the news tomorrow? Because tomorrow is the first day that the Magnificent Seven starts to report earnings, and the bar could not be set higher. Because what we've been talking about over the past several days is that corporate insiders have been selling their stock at the fastest pace since the late 1980s. And this is a huge red flag because it means they know about DeepSeek. They know what's coming for their markets. On top of that, what have we heard from Goldman? High net worth clients also dumping stocks. What have we heard from analysts? They're setting the bar high for this earnings season, meaning they're actually expecting companies to miss the high bar, sending the stock lower. And what is Wall Street going to finally start demanding? Something that investors don't want to hear. And why do they don't want to hear it? Because retail investors have been buying every dip as the big players are dumping. Let's take a look as this has now raised doubts about the market's future expectations of massive investments in AI. And what is the real issue with DeepSeek is they created an AI model at a fraction of the cost that these big companies that have invested hundreds of billions of dollars into their models, yes, perhaps are better. But what DeepSeek did is they did it on a budget. And what are we going to hear from these companies? That they need to spend even more money on AI. The problem is they may not. Now, Wall Street's going to demand something, and that is a return on investment. And Goldman told their clients on Monday that DeepSeek is allegedly 40 to 50 times more efficient than other large language models, ranking it now third among AI models. And again, this was done at a fraction of the cost. And this is putting Wall Street in a position that they're going to start demanding a return on investment from these companies. And that's an issue because this is something that nobody wanted to hear about. And OpenAI CEO Sam Altman has responded to the DeepSeek development. On X, he called the R1 model, quote, impressive, particularly around what they're able to deliver for that price. And will obviously deliver much better models. And it's also legit invigorating to have a new competitor. We'll pull up some releases, he said. But when you really think about AI, it's not being broadly adopted as many of these companies expected. And a lot of these tech companies kept pushing for technology that was faster and better, but they were running out of things to do because there's a certain point where you don't need something that's even faster than the already fast item that you have. So here is AI. Problem is, again, customers aren't adopting it. Businesses really don't know how to effectively use it yet. And the problem then for these companies is they plugged hundreds of billions of dollars into it. Now we see DeepSeek with a low-cost competitor. And I want you to put this in perspective. Think about when people fly. There are people that fly first class, and most people, they fly coach. And think about AI. How many people need a first-class high-end model? Well, probably not that many, and that's the issue. Because Goldman goes on that from a few conversations they've had with various investors this morning, the initial thoughts are similar. Negative CapEx impact and that meaningful change of narrative in the U.S. AI space is worrisome in terms of R&I, that is an ROI. So now it starts to make perfect sense. Why are executives unloading the stock? Because they don't have the return for their investment. Why are high net worth clients selling? Well, because they know what the big guys are doing. Why is retail buying? Because they're conditioned to buy every dip. And now these companies are going to have to start to explain why they're spending all this money on technology and there's no return. Wall Street's going to demand it. The issue here is when we look at this chart and we look at prior bubbles, we have the Nifty 50 bubbles back in the 60s. We have the internet bubble in the 2000s. And now we have the Magnificent Seven bubble. If this bursts because AI doesn't deliver or companies have overspent on technology that people don't need, well, you've got a problem. And again, this all comes back to DeepSeek, because if what they created is good enough for the average person to use, well, they did it at a fraction of cost. And again, you talk about airlines. This is why budget airlines are so successful in moving mass amounts of people, because they don't need the first class experience. They're not willing to pay for it. Yes, there will be customers that will pay for these high-end products of these AI engines. The problem is, will they be paying hundreds of billions? I'm not sure. But the other news that's coming tomorrow is going to outright anger the Trump administration. Of course, that means the Federal Reserve is going to speak on interest rate policy. And Trump says he knows interest rates better than the Fed Chief Powell. Well, it's not really hard, because virtually everybody knows interest rate policy better than the Fed. And that's, of course, the market knows it's best. So I'm going to show you what market expectations are. But the reality here is the Fed isn't going to budge. And this is going to outrage the Trump administration, because we know President Trump wants to see rates go down. Now, prior presidents don't comment on interest rate policy. Better believe he's going to have something to say, and it's not going to be pretty. But on top of that, you think about what's going on in the rest of the world. You have other central banks cutting rates. If the U.S. doesn't cut, that means you start to drive further discrepancy in policy and further discrepancies in currencies that is going to cause problems all around the world, and also potentially for investors. But what about households who are struggling under inflation? Well, what they could use is a little bit of relief, that is, at least on their credit card bill, but don't look for tomorrow for it to happen. I think I know interest rates much better than they do, and I think I know certainly much better than the ones who are primarily in charge of making that decision. If I disagree, I'll let it be known. Here's a question for you. Do you think President Trump is going to fire Fed Chair Powell? Now, we do know he cannot officially fire him, but he can remove him as the Fed chief. Would be very interesting. Weigh in the comments. Love to know what you think, because here's what the market says. When we take a look at the federal funds rate in blue against 6-month Treasury yields in red, what it's telling us is market expectations here, even though they're going to say the odds are low that the Fed's going to cut rates, which we actually know the Fed isn't going to cut rates. What that chart tells us is the expectations of what the Fed needs to do. They need to cut a quarter basis point. But look what some of the experts have to say here, as the U.S. Central Bank is widely expected to hold interest rates steady at the end of its 2-day meeting on Wednesday, marking the first pause in the rate cutting cycle that kicked off in September. And this is largely expected. Again, the betting pool of markets is saying the Fed isn't going to cut, but the bond market is saying they do need to cut. That's the issue here, because when we start talking about the U.S. economy, there's something that's going to have a far bigger impact on American households than just a simple rate cut, or the lack of a rate cut and the impact this means on debt service costs. Stay tuned, because it's going to be a year where the Fed can reduce interest rates twice, maybe once. And that's the issue here, is everybody saying, look at the U.S. economy, it's strong and robust, the labor market's holding up, inflation's still too high, and the Fed doesn't need to cut. Now, the problem is we've seen past cycles where the Fed has cut into rising inflation. So the notion here that the Fed even cares about inflation is just lip service to them, saying they have no clue what they're actually doing. But there is a problem in the economy. Consumers are starting to figure out. The media is starting to finally pick it up. We've been warning about this, but let's continue first. If you get that from the Fed, plus a little bit of deficit stabilization, is a pretty strong outcome for the bond market, again, setting up the potential for a fixed income rally. We'll see what happens, but here again, the issue is the Fed is unlikely to cut. The market says they're going to need to. President Trump is well aware the U.S. economy is slowing, and he wants to drive consumption here in order to support his agenda. He wants the Fed to cut. They're not going to. The problem is the U.S. economy, as you're about to see, is starting to fall apart. As U.S. consumer confidence now drops to a 4-month low on jobs market, this is from the Conference Board, and I want you to see that the media is finally starting to pick up the one thing that we've been talking about on the show for years that matters more than anything, and that is the labor market. The problem now is consumers are starting to raise the red flag. Meanwhile, the Fed's going to tell you labor market's strong and robust, but as you're about to see, consumers know best. The Conference Board's gauge of confidence decreased 5.4 points to 104.1 this month. The gauge of present conditions dropped nearly 10 points, while the group's measure of expectations for the next 6 months declined to a lesser extent. So what happened, we saw after the election, confidence surged. Everybody's excited. They said, hey, we got a new boss now, someone new to run the country. And what did I say? Just because you replace, say, a CEO or a government official or some executive, it doesn't have an immediate impact. And that's certainly what we're now seeing, is that consumers realize while they may have gotten the person in office they wanted, the trajectory of the economy is too big for a rapid change. Now we're seeing expectations come down and present conditions. And this is huge because it has massive implications on the U.S. economy. Let's take a look at these charts and we're going to break them down a little bit deeper. But look what's happened. Consumer confidence has been rallying, and then all of a sudden it's turned and starting to plunge. And we've warned this is what was going to happen. But look at the sheriff saying jobs are hard to get. This has been slowly rising since late of 2023, but yet hasn't really had an impact, hasn't really shown up. But now it's starting to be an issue because what is the other factor here? People are losing their jobs. And when they lose their jobs, it's not a big deal if they know they can get another one. It doesn't really have a massive impact on their spending because they do have savings to get through until they start another job. But what's the problem is when you lose your job now, you probably know someone who's been on the unemployment line for several months or more. That's starting to have an impact. And look at this. Finally, Americans are starting to believe that their income growth is going to decrease. We said this was going to happen. I'll show you why. But how about this? What have we seen from small businesses? They've been talking about how business is going to boom. But look what here you see consumers saying the share of business conditions that are good, well, it's plunging to very low levels. And inflation is only easing gradually. And while the labor market looks good on paper, job seekers say it's taking longer and longer to find work. And sentiment has been shaky as consumers assess how Donald Trump's policies will affect the economy. Of course, we don't know exactly how they're going to affect the economy because the U.S. economy doesn't move that quickly. It's very large. It takes a lot of time for new policy to come in and make a change. But what consumers are realizing here is if you lose your job, you probably aren't going to get another one, or at least not right away. The risks now are increasing. So there's a difference. Again, if you lose your job in a strong jobs market, you continue to spend money. It's not a major impact because you know at some point you can get another job. But in a market like this, if you lose your job, your spending is going to get cut. And that's a problem because the moment spending gets cut, well, it affects other people's income, and next thing you know, you start to spiral down. The share of consumers that said jobs were currently plentiful fell this month to the lowest since September, and a larger net share said jobs were hard to get. And what did we hear from employers? We heard from manufacturers and service providers, small businesses that said, yes, we're excited. We're expecting a boom, and well, we want to hire. But the reality is they're not hiring because what have they been waiting for? We said they were going to do this. They were waiting for one important thing, consumers to come in and buy. Well, consumers, they're not buying. The return of pessimism about future employment prospects seen in December was confirmed in January. Buying conditions for big-ticket items such as cars, houses, and appliances softened makes perfect sense because when people start worrying about money and where their income is coming from or how long it's going to last, they don't go buy big-ticket items that they usually finance and have to make payments on. So this is just a leading indicator of where the economy is going because as consumers spend less on durable goods, well, what it means, of course, there's going to be more people that are going to see their hours cut or even their job lost. And that likely affects still elevated prices as well as high borrowing costs, with the Federal Reserve poised to hold rates at an elevated level. We'll find out, of course, more tomorrow. But it has nothing to do with prices and interest rates because if the economy was booming, if you think about this, if workers were seeing that their business was growing, if they were seeing opportunity to make more money, they were going to get bigger wage increases, they would spend the money despite the fact that interest rates are high, would have no meaning to them. Wouldn't matter if prices were high if your income was going even higher. But weaker income prospects likely dampen consumers' vacation plans. Well, there's no doubt about that. If you're worried about your job and you're worried if you lose it, getting another one, well, one thing you don't do is go on vacation. And that dropped this month to the lowest level since October of 2022, particularly for international travel and by plane. So now you can see there's a massive shift in consumer confidence and expectations here that's finally hitting the real economy. Let's take a look at some charts here. We're going to switch to the University of Michigan data because the Conference Board is not in the Federal Reserve database. We're going to run that in blue against continued unemployment claims. That's shown in red. And what do we see? Going back to 2000, when consumer confidence goes down, It's because the labor market's unwinding. And here you see what happened back going into the dot-com bubble is happening today. People are losing their job, and their prospects for getting another one are not there. They're getting unemployment and staying there. The same thing happened around 2007. You see confidence rising up till it peaked. But what happened? Continued claims start to bottom out. And next thing you know, both went in the opposite direction. We see confidence plunging, claims rising. Now we go back to 2022. What do we see? A bottom in continued unemployment claims. But at the same time, we see a bottom in confidence. This is a little bit unusual because confidence rallied. We said this isn't likely to last because when you understand the relationship between confidence and the labor market, you start to realize it's only a matter of time before it reverses. And now the conference board says, well, it is. But let's talk about the job openings because this matters as well. When people go on the unemployment line, well, that means businesses don't need as many employees and they start to cut job openings. You see a near mirror relationship between the JOLT survey in blue and continued unemployment claims in red. Again, we go back to 2000. You see that diversion. Claims go up. Job postings go down. You see it start to happen around late 2018 into 2019. And now we fast forward to right around 2022. What do we see? A peak in job openings. Remember, this was now former Treasury Secretary, former Fed Chief Janet Yellen's favorite labor market indicator. Well, it's telling us that the labor market's getting worse, validated by continued unemployment claims. And how about wage growth? Again, we've mentioned this is all about the labor market. It makes perfect sense. When you start to see people on the unemployment line and you're an employer, you don't need to give out big wage increases. Why? Because if the employee's not happy, you can simply replace them. Here we see average hourly earnings of production non-supervisory employees in blue. This shown on a year-over-year rate change against continued unemployment claims, still shown in red. And what do we see? As continued claims rise, what exactly happens? Employers say, look, I'm still going to give you a raise, but I don't need to give you as big of one because if you don't like it, you can leave. Employee doesn't want to because they know they're not going to get another job. At this point, job hopping goes away. They say, yes, happy to take any sort of pay increase. And you see wage growth slow. You see claims rise right into a recession. And that's one of the key indicators here is you see this relationship over and over go right into recessions. Confidence goes down, unemployment claims go up, and income growth slows. Consumers cannot afford higher prices. Next thing you know, right into a recession. So you start to think back, why will President Trump want the Fed to cut rates? You're seeing it in the charts here. Why are you seeing these earning bars set so high? Because the analysts want the market to go down. They want to see everything changing here. And now we talk about durable goods new orders as consumers look to spend less. As U.S. core business equipment orders increase by more than forecast. Now, this is only, of course, what we talk about, the core part of this, excluding food and energy. But look at the details here, because when you do include food and energy, well, it's ugly. And guess what? That part of the economy employs people. Core capital goods orders, a proxy for investment in equipment that often excludes volatile aircraft and military hardware bookings, increased 0.5% last month after an upward revised 0.9% increase in November. So they're saying, look, the labor market's strong. People are consuming. They're buying core goods. Now, why are they buying them? Ahead of the tariffs. Now, we knew this was going to happen, so we're going to look to see if this drops off in the months to come. Based on confidence data, well, it suggests it is. And I'm quite confident sooner or later businesses are going to invest robustly, as various measures of business sentiment suggest that executives are remarkably upbeat about the economic outlook in the wake of the election results. And yes, these same executives that are dumping their stock and firing employees, no, it doesn't show they're confident at all. The manufacturing sector has shown signs of stabilizing after struggling last year. Well, that's not going to last. We're about to take another leg down, despite the fact that we see purchasing managers and supply executives expect to see manufacturing growth in 2025. Well, the labor market says, well, you're not. As we take a look at manufacturers' new orders, this is not core. This is the headline number. That's shown in blue on a year-over-year rate change against continued unemployment claims. And what do you see as people go on unemployment and stay there? Well, the demand for goods goes down. You see that as the blue line falls below the horizontal black line, you get a contraction. And as that happens, more people in the manufacturing sector and across the economy lose their job and get stuck on unemployment. And now we're seeing that here. So despite the fact that executives are saying things are going to get better, well, corporate executives that are dumping their stocks say, well, it's not. But one thing we are bullish on, and that is a stock for our sponsor of today's show, Encanics Healthcare. You can find them on the NASDAQ under symbol IXHL. And Encanics is a science-led combination medicines company focused on rapidly developing novel oral fixed-dose treatments and therapeutic regimens for people living with challenging chronic conditions. Encanics is developing medicines that target underlying biological pathways associated with disease. They're applying this innovative approach to address a range of conditions, including obstructive sleep apnea, rheumatoid arthritis, and generalized anxiety disorder, with a goal of delivering more effective treatments for patients in need. IHL 675A is a new oral medication combining synthetics currently being tested for rheumatoid arthritis. The combination aims to tackle issues with the immune system and reduce inflammation effectively. Encouraged results from earlier studies support moving forward with further trials to evaluate its safety and effectiveness. And PSX-001 is a new oral treatment being tested alongside psychological support for adults with generalized anxiety disorder. In early trials, nearly half of the participants experienced significant improvements in their anxiety levels compared to those who received a placebo, and the treatment was generally well tolerated without serious side effects. Full results from the study are expected available in early 2025. And Encanics Healthcare announced positive results from a study of its new oral medication IHL 42X, which combines two existing drugs to treat obstructive sleep apnea. The study showed that the medication is safe and effectively delivers the intended ingredients, potentially paving the way for future regulatory approval. The company is now preparing for further clinical trials to evaluate the medication's effectiveness in patients. And all this news could be a huge catalyst for Encanics stock price. Again, you can find them on the NASDAQ on the symbol IXHL. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.